welcome to the investment meeting for April 2014. Let's quickly go around the room, introduce ourselves for the record. Rosemary?
Good morning, Rosemary DeBillis, representing Police Commissioner Brent.
Barry Dennis, SAS.
Dan Torelli, PBA.
Joe Alejandro, PBA.
Chris McGrath, PBA.
Bob Ganley, SBA.
Steve Rebellia, LBA.
Chris Monahan, CEA.
Michael Palladino, DBA.
Bob North, Actuary.
John Dorsey, Control's Office.
Mark Gans, Controller's Office.
Susanna Vickers, Controller's Office.
Seema Hirani, Controller's Office.
Justin Holt, Finance.
Janice Emery, Mayor's Representative.
Kevin Holleran, Police Pension Fund.
Wesley Blissett, Controller's Office.
Okay, we are in the public session, and with that, let me turn it over to Seema.
Okay, thank you. So we have the February monthly performance review, which I think everybody should have in color in front of you. So you might remember, so when we went through the January numbers, which was the rockier month at the start of the year, lots of uncertainty going on in the markets, China slowing, what is the Fed Reserve going to do? Now we have a new chair. What are we going to do about the debt ceiling, which would have been resolved in February? So then we get into February, and a lot of that gets resolved. And you'll see when we go through the numbers, we had a very big month in February. As we then moved into March, back to the choppiness that we had talked about back in January. So why don't we just then turn to page 27 and walk through how strong the numbers were in February. Okay, so you see here the month there, the Russell 3000 up 4.74%. The EFA markets were up 5.5%. The emerging markets were up over 3%. Scroll down a little bit more to Core Plus 5, up about 75 basis points. High yield up 2%. Tips up 45 basis points. And converts up over 4%. So a very big month in February. You still along this way have had the Federal Reserve continue to taper their bond purchases. So you might remember they were doing $85 billion a month. They then went to $75 billion a month, down to $65 billion a month, and now we're down to $55 billion a month in terms of Fed tapering. I'll give you a preview of March. We're real up to date here because March 31 was just yesterday. So for the month of March, the Russell 3000 was up 53 basis points. The EFA market's down 55 basis points. The emerging market's up over 3%. Core Plus 5 down about 15 basis points. High yield down about 25 basis points. Tips down about 45 basis points. And converts down about 1.7%. So again, you see the choppiness going on in the markets. But overall, if you take the month of February, take the month of March, and January, we're still up for the year to date. If you turn to page 29. So for February, the 1 month total return in the left bar, the fund was up over 3%, so it's a big month. And you can see where the contribution had come from, the majority of it, clearly in U.S. equities. The fiscal year-to-date number then, through February, is up 12.6%. Now, if you add in what we just went through in March, which I would say we're roughly about flat, we're still now through March, then the total fund's up over 12%. So it's a very good number. On the next page, 30, this is how we're set up. This is our asset allocation. And as you can see here, we are within our ranges on an adjusted basis in U.S. equities and in Core Plus 5, which is what we've been managing to do and have been talking to the boards about doing. And here, at the end of February, the total fund was at $32.4 billion. And through March 28th, which again is the latest numbers that we have, but if you take it through to the 31st, we're about flat. So again, we're still at this $32.4 billion mark. So hanging in there strongly. The rest of the monthly, we now have the performance numbers by manager, so State Street has come through on that. We also have the cash flows in real estate and private equity. And if there aren't any questions on this, we'll move to the next item.
Executive session?
We have one more item.
One more item?
Yep. Okay, so next up, we have the emerging market debt education, and I'm going to first turn it over to Martin and then to Barry.
Thank you. So the emerging market debt piece starts on page 6. I guess Barry's going to go over there. The reason we're talking to you today about emerging market debt is that there's another one of the New York City systems that's going to be doing an emerging market debt search, the teachers' retirement system. And the reason for that is that they have extra room in their basket because they don't have hedge funds. Whereas police does not presently have extra room in the basket. In fact, if you look in your book on page 23, you'll see the basket room that we have, and this does not take into account monies that will be coming into opportunistic fixed income going forward, which will take it down pretty much up to the 25% limit, which was our expectation. So Teachers is doing this search. We also, as you know, simultaneously are planning on speaking with the folks in Albany to have relief in the basket to increase that amount from 25 to 35. In the event that that happens, the police board would be able to invest in emerging market debt. And Barry will talk about emerging market debt in just a moment. What we're ultimately asking is that in the event that that law, the basket law, does grant relief, the board can then look at asset allocation, tweak it, or come up with new asset allocation, which either does or does not have emerging market debt. If it doesn't, it doesn't. If it does, if you go along with the search, you will then be able to pick fresh managers from a fresh search that your consultant participated in. You have no obligation to do so, so it's effectively a free option. You have the ability to consider this, but no obligation to actually invest in it. And in fact, the consultant may or may not recommend it, even with the 35%. But this gives you the ability to do so, if and when that happens, and we expect it to happen soon. The other thing you need to know is that EMD is an asset class that has many different flavors, as Barry's going to talk about. Some of which go in the basket, some of which doesn't go in the basket. And in fact, presently we have some investments in emerging market debt that are investment grade, U.S. dollar denominated, in our investment grade portfolio. It's actually in our index, in the Core Plus 5 index. But what we're talking about here would be different, which could be U.S. dollar or local currency. The local currency would go in the basket, and potentially the U.S. dollar would also, if it's below investment grade. So, unless you have any questions, I'm going to turn it over to Barry, but I want to give you the intro as to why we're bringing this to you, because we're doing the search anyway, and we want to give you the opportunity to consider tagging along, and in the event that you have the opportunity to invest, you'll have it right there, fresh, with results.
Okay. As Martin said, participating in this search gives you a free option. You can do it or you cannot do it. So it's probably a good thing to say, well, let's go along with this. And even if you, at the end of the day, say we don't want to do this, the city would get the benefit of SIS research. Now that might be debatable whether that's a good thing or not, but you do. And the basket is going to, to me, that's the important step that would allow you to do this, or really encourage you to do this. And I think when I went over the capital market assumptions back in January, I showed you how things like high yield, bank loans, hedge funds all have similar risk-return expectations and all tend to go in the basket and they compete with each other for that space in the basket. And you can see from our forecast, EM debt is right there with high yield and not too far off from bank loans. And if we put hedge funds on this page, they'd be about in the same risk-return category. And you have to think that given that U.S. fixed income has a low expected return attached to it, to the current low yields, that this is a way to help the fund achieve its assumed rate of return while keeping a reasonably high fixed income exposure. So we go to the next page. This is a little bit different than investing in corporate or mortgage-backed securities in that the current economics of who's ever issuing these bonds are not a big important factor. And by I mean current, I mean the current deficits are not as big as their overall fiscal condition or what's going on politically. But I want to say, 20 years ago we thought of emerging market debt as a big credit risk, that you were really worried about Argentina defaulting. I mean, that was a big deal back in the 80s. Various organizations put out fiscal strength scores on countries. There was just one in the latest Institutional Investors. Barclays, the index provider, puts out fiscal strength scores. And actually, when you look at the emerging market government-type indexes, they tend to have higher fiscal strength scores than the developed markets. So the world has changed. And if you look even within the developed markets, you would be surprised that which countries are at the bottom of that stack. And in at least like the Whigby index, Japan is rock bottom. We used to think of Japan as a very credit-worthy country. And the United States is not that far ahead of Japan in that fiscal strength score. So the fiscal strength score of Japan is 1.75 currently. The U.S. is 2.25. And you have countries like Sweden that are 6 or 7. So let's just accept the fact that the world has changed considerably over the last 20 or 30 years. And this class of fixed income has changed more rapidly than the world. It used to be all U.S. dollar denominated with some U.S. guarantee, what we call Brady bonds. Today, that's a fraction of the total universe. And at the same time, the universe has grown from 300 billion to 2.6 trillion, or a factor of over 8 times in the last 15 years. And the bottom point, I think, is reasonable to consider from a policy point of view as well, that because the number of instruments have expanded so rapidly in this area, along with the broader universe, the potentials for managers to create extra return has also expanded.
Just want to also add, I did this in another meeting, the size of the market, which surprises a lot of people, is bigger than the high yield market in the U.S. So it's high yield can be illiquid. Emerging market debts actually can be more liquid in many cases than high yield, or traditional high yield. So it surprises a lot of people when they hear that.
The next page just gives you sort of a graphic of how the landscape has changed, and this only goes back 3 years, so that the change has been much more drastic over the last 15, but you can see the change continues. But it's probably a good time to clear up some terminology that not only I'll be using, but when you talk to managers, that they'll be using. And we basically looked at emerging markets today as having 3 main sectors, where it used to be just hard currency bonds, and most of that hard currency would be dollar. Today we talk about hard currency bonds. We talk about local currency bonds, which are sovereign debt but are issued in the currency of the country that they're originated in. And then there's corporate type debt, just like we have in the U.S. And those are the 3 main categories that we'll be talking about. Where I said It used to be all hard currency dollar. Today, that hard currency component of the broad universe is only about 32% of it. The local currency sovereign stuff makes up about 40%, so it's bigger than the hard currency stuff. And the corporate stuff is almost as big as the hard currency at 28%. So it's become a very diverse universe of securities, which on the next page sort of just gives you a graphic of how the alpha opportunities for the managers have opened up. Within hard currency, they can choose between credit and sovereign debt. Between local currencies, they can choose between credit and sovereign, with a number of different types of issues within those. There are emerging market tips available. There are asset-backed securities like mortgages, like we have in the United States. And there is also the currency decision in anything that's priced in local currencies that the managers can make decisions on to improve the returns of the portfolio, hopefully. On the next page, I think you see, the story that we've been hearing for 30 years, and the story continues, that emerging markets are the drivers of global economic growth. And even though we see those growth rates slowing, so if we look at the developing economies, which means emerging markets, it's gone from 8% real growth to 5.4. The developed, this is over the last 10 years, the developed or advanced economies, were at 3%, dipped to about 1.5%, and now have clawed their way back to about 2.5%. And most of that is coming from the United States. The other developed regions of the world, Europe and Japan, are growing at much slower rates than the U.S. But the developed countries are still growing at less than half the speed of the emerging economies. And you can see it will probably be in our lifetimes, I hope, that those two lines cross. The next page addresses what other pension funds are doing, and you can see that this is becoming a growing area of your peers' allocations. Today, in the United States, about 1.7% is the allocation across the board to emerging market debt. About 11% of pension funds have an allocation to emerging market debt. But the point is, it's up from 6% just 3 years ago. Now, we're going to look at some yield history that says the people that invested in 2010 and 2011 aren't very happy investors today. But in my mind, that creates an opportunity for the police getting in at a more favorable price. On page 8, we'll look at some of the historical risks and returns of emerging market debt. So on the left is a 5-year risk-reward chart, and on the right is a 10-year risk-reward chart. What is consistent over both the 5 and 10 years is that the risk of emerging market debt relative to U.S. investment grade fixed income is about 2 times. And that's in our forecasts, and that's what history has told us. What we see is over the last 10 years, it's been a remarkable performer, competing pretty well with high yield, which we know has been a great asset class, and well above U.S. fixed income. And then if you look at the last 5 years, the return premium is not quite 2x, especially in the local bonds, which got hit hard in the global fixed income, in the global financial crisis, but still about 2x if you combine both hard currency and local bonds, the U.S. fixed income return. So 2 times the return, 2 times the risk. Maybe you don't want to do that, but we're going to look at correlation a little bit later, which will say, if you add this in to U.S. fixed income, now it makes a lot of sense on a risk-reward basis. On the next page, we'll see what's happened to the yields. And the blue line is in the local currency, and the green line is in primarily dollar denominated. Although this hard currency is now, you might see some denominations in euro, yen, or British sterling. But they're typically issued in what are considered the blue chip currencies. And you can see that these have pretty high yields. If we look way at the right, which is the current yield, the hard currency bonds are yielding right around 6%. And the local currency bonds right around 7%. Now compare this to 3%, 4% in the United States, and you see the valuation case for investing in this asset class. What you also see is over the last 2 years, these yields have gone up by 50%. So that was my point. When yields go up, prices go down, that people who jumped in this asset class 2 years ago are not very happy. But we're seeing a much better entry point today. I guess this would be a good time to talk about emerging markets in general. And if you look at your monthly performance review and look at some of the numbers there, we look at emerging market stocks. Over the last 3 years, they're down 2% per year, while U.S. stocks are up 15% per year. So if you accumulate those returns over 3 years, you've got about a 60% cumulative underperformance of emerging markets versus the U.S. If you look at 2 years, it's about 50%. Big underperformance coming from there. And we see the same pattern, but much less extreme in fixed income. Then you have to say, why is this happening? We thought emerging markets are growing so fast, they're always going to be great investments, but they haven't been. Whether they will be for the future, we don't know. But we're certainly at a better price point today than we were 2 or 3 years ago. Now, I don't have all the answers, but I do know a couple of things. 3 years ago, we thought these emerging markets were going to build their middle classes and become internally driven economies. That people would start making more money, they'd start buying more stuff, and these companies could sustain their own growth without a lot of dependency on exports. That hasn't come close to happening. They're still very export dependent. And while it's true that more people in these countries are making more money, it is not true that they're spending that money. They tend to save it. And that doesn't help economic growth. And it is also true that these economies are still dependent on outside sources of capital to continue to grow their economies. And that is getting harder to attract because the yields, the price of investing in those countries has gone up so significantly, as we see on this chart today. And there are particular economies that import more than they export. So they're really in a deep hole. And that would be countries like Turkey, South Africa, Indonesia, that don't have a lot of natural resources to export, and they're tending to drag the whole ship down. Now that will continue until it doesn't. And when it doesn't, the reason it's going to be going up is because it's gotten so cheap that it's worth it to invest money in those countries, those economies, even though the economic growth may not support that today, but it will tomorrow. And also, if you look at the monthly report, there's a chart in there, I'll go back to equities again, that shows the PE ratios. And if you look like at the emerging market stock market, it's trading at about 7 or 8 times earnings. We're at about 16 times in the United States today. So it's on sale for 50% off. That's one way you might look at it. And the same thing could be said about the bond market as well. Maybe not to that extreme, but it's on sale relative to the U.S. On the next page, we just show that in the corporate market, you're getting additional yield relative to the U.S. market as well. On page 11, we show you the rationale that if you did do this, you'd probably want to be active. You wouldn't want to index this asset class. And the charts on the left are excess returns. So, for instance, when we see the median at 10 years at 0.68, that means the 50th percentile manager has beaten the index, and in this case, it's a global sovereign index by 68 basis points. And over the last, say, 5 years, the manager has beaten the index by almost 500. So it's a healthy market for adding value. But if you also look at the bottom chart, where we go year by year, the managers got killed in the global financial crisis. Now, part of this is because they're being measured against a sovereign index, and they held corporates and hard currency debt. But over the long term, this has been a very fertile ground for active management. On page 12, this is where you sort of get the asset allocation or the portfolio theory case for including emerging market debt. And even though it's like 2x times return and 2x risk, the correlations, for instance, to your U.S. portfolio are very, very low. Let's average the 0.10 and the 0.22 and get to 0.15. That's almost independent price movement. And that is how you get an increase in your Sharpe ratio or your return to risk ratio by including assets that don't move together. And this is a very good example of an asset class that will help diversify the fixed income portfolio. The last couple pages just talk about what's in the indexes. We're not recommending an index today. I can tell you that most of your peers use either the EMBI Global or the EMBI Global Diversified, which means it's dominated by hard currency sovereign debt. The difference between diversified and global is that diversified caps the amount of issuance to any one country. That seems to make a lot of sense to me because you might not want to have the weight of over-indebted countries that it appears in the global index. Usually I'm a market cap weighted index guy when it comes to fixed income. I can cheat.
I can also point out that the numbers that we've looked at, the tracking error of the typical active managers in the universe databases are for fixed income equity-like. They're extraordinarily high. It's not as surprising to see 2, 3, 4, 5, 6, even 7% tracking error. And what that says is either, number one, it's the wrong benchmark that they're comparing themselves to, or they're not managing to the benchmark. And the answer is really it's the latter and a little bit of the former. The benchmarks themselves are very flawed because some of them are only hard currency. The most common ones are only hard currency. While Barry mentioned a couple of other benchmarks, the managers are looking at individual issues, many of which are not in the benchmark for one reason or another, and the benchmark issuers are very few and far between. JP Morgan dominates this.
And we could end up with some sort of blended benchmark as well, where we include both sovereign and corporate debt, hard currency and local currency. That is yet to come. And on the very last page, you see the makeup of a hard currency benchmark, a local currency sovereign benchmark, and a corporate benchmark. And you see the relative sizes. As I said, the local currency is now the biggest at about 40%. And at the bottom, you see the main issuers in each of those indexes. In conclusion, I just say that from an asset allocation perspective, this makes sense, particularly in a very low interest rate U.S. environment. Number two, it appears that the potential for value added by managers will add to the appeal of this asset class. And number three, the entry point today is a lot better than it was 2 or 3 years ago, which should give you some encouragement to participate in this process. Any questions?
You know, Barry, on page 3 of the presentation, you comment a reasonable alpha forecast of 25 to 50 basis points. Is that after expenses? Or
Yes, that's after expenses.
And what are expenses typically for a well-diversified emerging market debt portfolio?
I would say at your size, we would probably be able to negotiate fees between 15 and 25 basis points. But maybe Martin wants to chime in there. Maybe I'm building too frosty.
It's premature to say precisely because it depends on what we see. There are about a half a dozen different universes. So there's local currency managers that focus on local currency, managers that focus on hard currency. There's managers, if you want to look at corporate debt, there's managers that do all the above. There's managers that hedge, that don't hedge. And so there are different costs associated with all of those. So it really depends on the ultimate recommendation that we come up with. But what Barry said is not unreasonable.
So we just completed a search for a state pension fund that is about 1/5 the size of the total New York City retirement system and got a fee of 24 basis points. So you could probably do a little bit better than that. Yes, please.
On page 7 of your presentation, you talk about, and I want to make sure that I'm interpreting this correctly, the top chart shows that 1.7% of domestic U.S. pension plans have an allocation, or the allocation is 1.7. So the allocation on average is 1.7%. At what level should a plan consider a standalone manager versus expanding the mandate of existing managers to invest in emerging markets?
I would say around 3%.
So 3%, is it about the allocation where you would want to have a standalone?
Where you have a separate allocation.
A separate allocation.
And for a big fund like yours, you might want to go down to 2%. You know, those rules of thumb have been changing as the number of asset classes have proliferated. 20 years ago, I would have told you 5% was the minimum allocation. But today we have 10 asset classes instead of 5. So that number comes down.
Okay, Barry, on that page, 1.7, does that include all the zeros? Is it an average of?
Yes.
So it does include
Right.
that.
And it includes all the core plus managers that are like. So it's percent of the total allocation, whether it's discrete or part of a broader assignment.
Can I ask one more question?
Sure.
The way we're approaching this today, and I agree that it's a good thing to piggyback on another search, because in the event that we do want to add emerging markets, we won't have to do a search on our own, which I think is a good thing. But we haven't picked a benchmark yet, and you were alluding to the fact that you're thinking about perhaps a blended benchmark. How do we ensure that managers are included in this search can manage to whatever benchmark we pick down the road if we haven't chosen it yet? Is that at all a concern, or can these managers that we're looking at pretty much manage to any benchmark we provide?
Well, this search is not, unlike some other searches that are in the queue here, are not dependent on contracts expiring. So we are probably not going to get started on the search till later this year and finish early next year. So the idea is that we will work out those issues before the search is finalized.
I also like to point out that the issue of the benchmark will be ultimately related to what the ultimate recommendation is to the boards. So we can come up, as Barry started his comments with a blended benchmark, if that makes sense. Sort of like we have the secondary benchmark for convertible bonds, because the primary benchmark, no one is managing towards that. So we'll come up with a list of managers, whoever those best managers are in those different categories. Those managers will have appropriate benchmarks, and we can then have a program benchmark that reflects what it is that the program is investing in. And that will be part of an overall recommendation when we have the search results ready.
And that'll also be part of the IPS that we'll create around it.
Correct. That's right.
Somebody kind of piggyback John's a little bit, connect the comptroller's office. Well, Barry, part of it, we always have an important thing done in a timely fashion. And a lot of times we wait for the clock, before the horse. And I get come in at once, finally, we're looking to do something concurrently and kind of work it out while we're going on. So, thank you, Barry. Thank you, Lonnie.
I also want to introduce Wesley, who's behind me over here. He's been doing a lot of work for us on the emerging market debt search or evaluation, and we'll be working on the emerging market debt search process, so don't blame me.
Look at that.
Welcome to the politics, man. Right under the bus, right off the bat.
We're collaborative now.
All right.
So really
Any
the
other
next step.
questions?
So I want to go with the next steps. Next steps will be we're going to work with the consultants, come up with a scope for a search. We'll come back to the boards with that scope, and as soon as we get agreement on the scope, we'll start the search. And we'll have results soon after that, because hopefully it doesn't take that long because of the process that we have. And again, if we have the basket change, that we can then immediately select managers at that point. But those are the next steps for the board's permission to use SIS in this search process.
Go forth and serve.
All right.
Thank you.
Thank you. Thanks, Martin. So that completes the public session.
So we need to make a motion to leave executive session and go, in public session and go into executive session for the purposes of reviewing investments before the board and reviewing manager performance and any actions, discussions after that on manager performance.
You have a second?
Second.
Okay. Let's just